Welcome back to Open Exchange. We've had 6 weeks of talks between gold producers and unions in South Africa, still talking, increasing the prospect of strikes in that industry, which of course is already battling low prices and high costs. Joining us now to review production figures, earnings and the mining landscape generally after several of those companies reported is Herbie Geldenhuys, who's Platinum Analyst at Vunani Securities, Jacques Botha, who's Chief Mining Economist at Pan-African Research. He joins us from Cape Town, and Daniel Hoyer, who is KPMG Lead Partner for Gold Commodities. Well, let's start with you in Cape Town, Jacques, and let's just take a big picture here. They say when things are most gloomy, you must invest, and certainly the commodity sector has fallen on hard times in many respects, and there's been a lot of gloom about it, and the resources indexes have lagged and so on. So let's just step back a bit here and see where we are and what the future is. Let's take a look forward in terms of prospects for commodities broadly.
David, yes. What happened is the miners have actually have their expectations were higher than what happened, and there's been a lot of investment in production. And meanwhile, it seems that the super cycle had slowed or sort of disappeared in the markets, and prices in general came down, rose slower like iron ore, but in many cases actually came down. So people were caught unawares, the mining guys, and there's been a lot of blood on the ground there. The future, though, looks now, we actually believe we've reached the bottom. So the future is actually not so bad. The big reason here is we see growth, global growth in the world picking up slowly, but very slowly. But the big difference is this time around, we have 4 major economic groupings now taking part. So the world is actually now running on 4 cylinders. In the olden days, we had Europe and America. Then we had Europe, America, and Japan. Then Japan fell out, and then we had China, and as it went. Now, all 4 of these economies are getting ready, and you can see it, and everybody sort of, the signals are there from in different ways, getting ready for a good, strong, slow but accelerating growth. So the world is now suddenly running for the first time in history on 4 cylinders, which is actually very positive for commodities.
Thanks, Jacques. We'll pause at that moment there. It's unusual to have such a cheerful note in this discussion that we have about resources, Herbie. The 4 areas of the world growing for the first time in history, Jacques points that out. It's a simple concept, but very important.
Oh, yes. The platinum group metals gets used extensively in autocatalysis. In fact, 50% of PGMs consumed globally goes into vehicles. And if you consider that as little as 10 years ago, roughly only 10% of metals went into developing markets, that's PGMs. By 2017, roughly half of those metals will be going into developing markets, and the key one there being China.
Now, China, Daniel, is everyone talks about Chinese growth, and if it drops to 7%, then everyone says, oh, it's a disaster. It's still huge growth.
Definitely. I think you've got to look at the global demand out there. I mean, urbanization, key factor, and population growth, demand for raw materials. So what does that mean? That means that there's scarce resources in the world. Iron ore, gold, copper, and funding of those operations, specifically capital expansion projects and exploration, has decreased. Now, with demand going up and a decrease in funding, there's looking to be some challenges going forward, and you've got to ask, is it going to be sustainable?
Isn't the danger with China, Daniel, is that we look at those numbers and they're clean and hard and you dispute them or say they're good or bad, but behind it, China has big issues, environmental issues, how their economy is working with investment in big infrastructure as opposed to consumption, and they're trying to shift it?
Yeah, I think they're looking to slow down. They've announced they want to slow down over the next couple of years, and we've got to think on ourselves, what's that impact going to be on the developing world and developing nations and economies which are producing all these commodities for them to consume.
Yeah. China, are there problems there that are being stacked up but we haven't taken full account of?
David, pollution in the big cities in China is completely out of control. It is a big problem. And the big polluters are the trucks and buses. They are at this stage not fitted with any autocatalysts, mainly because the quality of the diesel that you find in China is of a poor quality. In China, the best diesel that you find is about 350 ppm sulfur, and in order to fit a decent sized catalyst, you need at least 50 ppm diesel. Now, a truck consumes roughly 6 times the amount of PGMs that a vehicle consumes. That's about 20 grams versus roughly 3.5 grams. China is the biggest producer of trucks in the world. The global truck market is roughly 4 million trucks and buses, of which 2 million are built in China.
Gee.
So clearly a huge market. And I fear if current trends persist, there might not be enough metal available to satisfy such demand.
Wow, so a platinum sector that has been really struggling in the last year. If you're looking at that outlook and not enough platinum available, we're looking at prices perhaps that go back to those mid-2000s where Amplats, I think, was at 1,400 Rand a share. But bringing you back in there, Jacques, so Herbie has talked about the platinum demand long term. It sounds very positive. Let's look at the big commodities that South Africa is exposed to and the prospects for them, platinum and the others.
Oh, David, is the other expert there, the other guru is here, gold expert, I believe. So could I focus more on coal and iron ore maybe?
That's fine. Carry on with the coal and iron ore.
Okay. Right. So the interesting thing about iron ore is, again, the China story. What we've seen is, as everybody was expecting, and China promised they're going to shift the economy away from investment and export-related economy to a more local consumer-driven economy. That changeover, for many reasons, did not really happen, and it seems now, and we can see it, that China is still going in the old story of fixed investment. However, there are also changes in the type of investment where the investment is now more technologically driven and also trying to stop pollution. So the type of, even the steel making processes, there's a lot of drive even to make sure that there's less coking coal burnt. So there is even a risk that steel making is going to shift away from China. Well, it's not even a risk, to other countries where at this stage they are importing pollution because they're making steel for outside people. China, as we know, is produce 50% of the global world steel, and that could shift. But the demand, now the question is about iron ore. The iron ore producers are actually, the good iron ore producers are doing incredibly well. They have got incredible margins, super margins in the industry. So they're not, and China's been buying the iron ore, they've been importing it. And there are mines in China that are now, as the price goes down, will cut their production, which actually could lead to further iron ore demand. Over the long run, it seems that there could be a slowdown in demand for iron ore as China really shifts away from heavy metal smokestack industry consumption. But in the short term, it's still very good for the iron ore producers. Coal, on the other hand, has a problem. There's definitely a pressure, even in China, there's a pressure from moving away from coal-burning energies to other coal-burning energies, although many power stations will still burn, for many years will burn coal. So the coal price has fallen significantly, even in South Africa. Our own coal production year on year has been flat. Another reason for that coal production was the American story, where the gas price, the cheap gas price from fracking, allowed power stations to switch away from coal to gas. And at the current gas price, it's actually, the gas price is actually low enough so the coal is not being used. As gas goes up, there could be a shift. But in this interim,
Jacques, I'm going to have to stop you there.
Miners,
just let's pause on the iron ore and the coal.
Okay.
We've actually got platinum, iron ore and coal. It's quite neat. So let's work to Daniel. You are a gold specialist.
Yes. I think you're seeing, yes, there's been a hell of a lot of volatility in the price. And if you look at demand right now, demand has decreased. But having said that, central banks are still buying gold. Probably the most significant thing is a lot of people are moving out of EFTs, so exchange traded funds, but moving into gold coins and gold bars. And this is generally driven by a lot of demand in India and in China. So I don't think it's alarm signals yet in the gold sector, but I definitely think there's things you've got to look at. Bringing it to South Africa, we've got a lot of deep level mining in gold in South Africa, and there inflation comes in. You know, we all know mine inflation is higher than normal inflation, and having a look at things like labor, things like electricity, and things where expansion projects have been put on hold as a result of these prices. We're lucky in some instances because there's a rand hedge, but in others, you know, there's definitely some pressure, and definitely cost pressures on mining right now in South Africa.
Well, iron ore and coal will always be in demand. I'm feeling a lot more cheerful this morning about platinum and gold now, having listened to Herbie Geldenhuys, platinum analyst at Vunani Securities, Jacques Botha, who's chief mining economist at Pan African Research in Cape Town, and Daniel Hoyer, who is KPMG lead partner for gold commodities.